Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by ShareFile. Look, if you move any sensitive documents, if you're in real estate in any way or any business that's dealing with documentation you're providing to someone, you want to protect it. And we found the perfect system. It really helps us with collaboration. Check it out, sharefile.com. Well, we have a great show for you today. We're going to talk about the multifamily market. And, it's kind of interesting because we've all heard that there's not enough multifamily, there's not enough housing, there's not enough new supply. So, we're going to need a lot more housing, a lot more apartments built. But then we see signs of distress. We see signs of some rents maybe flattening out. In some cases, in some markets, actually reducing. What's going on? What's the future of the multifamily market, and how's the market doing now? Well, please welcome my guest is Carl Whitaker. He's Director of Research and Analysis at RealPage. Carl, good to see you, sir.
Likewise, I feel like it's been a while, Michael, but always good to catch up with you.
Yeah, thank you. So, first of all, if you will share with our audience, overall around the country, how is multifamily performing right now?
Yeah, I think you framed it up there really well at the onset, just talking about how much of an impact supply is having on localized fundamentals. I think if we really zoom out a level above that, look at what's happening across the country, multifamily demand by really any metric is very, very strong. The first 6 months of 2024, we saw as many units absorbed as we did in the first 6 months of 2021. And I think a lot of us thought 2021 was a point in time that would never be repeated. Now, thankfully, the drivers of today's sort of demand boom are very different than they were in 2021. But the end result is that demand is excellent. What's different between then and now is a 40 to 50 year peak in new supply. And as you point out, that's keeping rent growth compressed. It's keeping occupancy at a healthy level, lower 94% range, but there are a number of markets that it's realistically going to be another 12 to 24 months before we see occupancy get back up to that, historically normal 94 to 95% level.
Yeah, and that's interesting. 94% to some folks in the industry the last several years think, oh, that's kind of low. But, I grew up in the multifamily world. That's how I got started. And I'm like, if we could keep 94%, we were always pretty happy.
Yeah, absolutely. And especially in these Southeast markets that just historically, the Atlantas of the world, the Houstons of the world, they've always been the markets that have built the most. And because of that, as you point out, historical occupancy of 93 to 94% is, again, a healthy range based on those local market, those typical local market readings.
And what do you expect, Carl, for performance moving forward?
I think if I'm looking forward to 2025, obviously right now is 2025 is on the front of everybody's mind. We're going through budget season. We're trying to forecast 12-month revenue growth. I think the biggest thing we're going to see is a big emphasis on stabilizing occupancy. Now, again, the good news is that demand has improved. It looks excellent, but we've still got another 12 months at least of a lot of supply delivering. I think realistically, a number of markets, you're going to see rent growth and occupancy slightly higher than it was this year. However, it's still going to be below what historically was considered normal. So I think 2024, in summary, was really kind of the year that the market found its baseline. 2025, a little bit of improvement outside of a few spots that I'll talk on here in just a second. And then getting into 2026, I think you're going to start seeing more of those 2018, 2019-esque performance ratings, but it's going to be another few months before we're there.
So, Carl, I know new supply can take years in some cases to get rolling. Is new supply slowing down any?
Yeah, I love that you call that out, Michael, because that's such a key fundamental right now in the market. Really what we're seeing delivered today, that 40 to 50 year peak in supply that I mentioned, a lot of that was the permits and the starts that happened in 2021 and early 2022. Now, anybody that's kept much of a pulse on the economy over the past couple of years knows that that was prior to these big interest rate hikes that we saw. So really, today's delivery total looks substantial, but the construction numbers are actually down about 20 to 25% below the peak. And if you look at a more recent construction number in the form of, say, new multifamily starts, they have come down just such a degree that we haven't seen really since the great financial crisis. And I'm going to throw out a number: about 40,000 new units started during second quarter 2024. The last time we saw fewer than 40,000 units start in a given quarter, 2011. So you're going to see really by 26, the short-lived wave of supply, of oversupply, I should say, that's going to be a pretty short-lived period. And by 2026, we're going to see those numbers start to look even lower than we did in the 2010s in terms of realized deliveries. It's going to take a few years before we get back up to that, call it 300,000 units delivering level. We're probably looking at 26, 27, 200 to maybe 250,000 units delivering.
Wow. So does the slower new supply, does that bode well for these newer Class A type apartments to start performing even better? And is that kind of keeping cap rates low on these properties?
Yeah, the Class A segment is in a fascinating spot right now. I think conventional wisdom would tell you in a period of a lot of supply, Class A, really of any industry, but especially apartments, would get hit the hardest. What we've actually seen, though, is, at least in my view, partially because the single family market has become so expensive, we're seeing a larger share of renters elect to renew leases for longer than historically, particularly in that Class A segment. And I'll point to a talking point that you hear on all the REITs and their earnings calls. Almost every major REIT in this last round of earnings calls reported a 50% reduction in the number of move-outs to single-family homes. So if, I'm just going to use a nice round number here, if 10 to 15% of your move-outs were to single-family home ownership, now that's more like 5 to 7% based on that 50% reduction. So you've actually got a stronger occupancy in Class A than you would think, considering all this new supply delivering. I think the other thing we see too, and this kind of also defies conventional wisdom, more supply delivering actually makes Class B and Class C apartments more affordable because it adds to aggregate inventory. And what we're also seeing, Atlanta being an excellent example of this right now, Class A apartments are able to actually pull some demand out of the Class B rental housing pool. Class B is doing the same with Class C. And again, it really shows that even though new inventory is often delivering at the top of the price spectrum, it actually helps make more affordability. It helps drive affordability, I should say, in Class B and Class C properties in particular.
And how's that impacting performance on B and C properties overall?
So Class B was, and again, perhaps surprisingly, but Class B was over the past 2 years kind of the laggard in the market. We saw that Class B rent growth and occupancy was trailing that of A and C in a number of metros. Today, Class B really kind of seems to be finding its footing. It goes back to that point I made earlier that occupancy is kind of starting to get back closer to historically normal. Still going to be a little bit before we fully get there, but it is getting back on the right track. I think Class C in particular is where we're seeing some more of the headwinds, and a lot of that is related to economic headwinds, headwinds tied to job losses in certain sectors. We're also starting to see some headwinds in terms of or I should say we're continuing to see rather some headwinds in terms of things like rent collections and delinquencies. That seems to be impacting that segment of the market more so. Conversely, Class B, in a similar manner, has kind of got back on track in a number of ways, both in terms of demand, occupancy, and on rent collections and delinquencies.
Carl, are there any submarkets or cities that kind of jump out as far as performance goes?
Yeah, in the Southeast, there's two markets that I'll point out that have really kind of defied expectations in terms of strong performance despite a lot of supply. Those two markets are Charleston, South Carolina, and Savannah, Georgia. In some ways, those markets kind of fit a similar profile, smaller coastal towns that I think have, the secret has got out, so to speak, that they're cool markets. They have strong local economies. They kind of have this je ne sais quoi, if you will. And I think that those two markets are good examples of how demand can indeed match the pace of a lot of supply. On the other side, two markets that have been a bit disappointing here as of late, Atlanta and Nashville. Now, Atlanta, I think, is a little bit of a harder story to tell. You do have a lot of inventory delivering, but we're seeing a lot of challenges with rent collections and qualified leads in that market. Finally, Nashville, all considered, is actually performing okay considering how much inventory is delivered. But we're just seeing, again, a once in the really a once in a two generation level of supply delivering there, and that's keeping performance a little bit softer, at least among the Southeast markets.
Yeah, it's interesting you mentioned Savannah. I was down there doing some business, brokering some properties down there, and it is a very cool market, kind of a fun place to visit. But of course, a lot of growth with the expansion of the port and everything down there. What do you see, Carl, about velocity of sales and cap rates, kind of valuations on these apartment communities today?
Yeah, the valuations component is a fascinating one. I'll put a pin in that for now. In terms of sales volume, I think much like the multifamily performance readings, we're kind of seeing that sales volume maybe found its floor in 2024. Now, 2025, I don't necessarily think that we're going to see this huge snapback in transactions activity, but I certainly think you're going to see a lot more than you saw in 2024, partially with some of that being driven by now the expected interest rate cuts coming at the end of September, and maybe even once more in November. Now, obviously, that's still TBD in terms of the degree and depth of rate cuts, but I think that's going to spur some investor confidence. On top of that, though, the fact that you now have stabilizing occupancy, you have strong retention, you kind of have this return to normalcy in some ways. I think that's going to further spur investor confidence. Now, there's still a little bit of unknown on the valuations side. What I'm going to keep on hearing in the market is you kind of have an inverted bell curve in terms of what's actually trading. In other words, you have a huge, or I shouldn't say a huge, but you have a large share of what's trading is your ultra luxury top of the market class A. And then the other share of what's trading is your more affordable class C inventory that maybe the distress that we hear about actually is happening in that market segment. Again, you're not necessarily seeing that kind of bread and butter class B style apartment trading right now. And I think that as the industry continues to stabilize, you'll see some more of that starting to trade. And just based on the law of averages, most of your apartment product is class B. So as that property tile starts to trade again, that's going to raise overall, that's going to increase overall transactions in the coming month.
It's interesting. It seems like cap rates for multifamily have not risen as much as they have in other property types. In a lot of cases, cap rates lower than the interest rates we would pay on a mortgage. Is that what you're seeing, and do you expect that to change?
Yeah, it's a good question. And I think, a lot of one of the drivers for why we're seeing cap rates remain stubbornly low in apartments is that, again, there's still that investor appetite. Sure, it's not the same degree of capital that was chasing apartments as in 2020, 2021, or 2022. But when you look at a share of overall commercial real estate transactions, multifamily is still kind of the favored asset class. So you still got a lot of capital chasing these properties. And again, on the valuation side, as it kind of relates to that cap rate influence, again, it's important to remember that you have that super high end, top of the market trading in terms of the class A properties. And then we can buy this at a discount on the class C side. So you still got this kind of hard balance to figure out in terms of what an actual valuation is today. And with that has been some cap rate compression. I think realistically, we'll see cap rates come up a little bit in the coming months simply due to the nature of easing interest rates. But I don't think you're necessarily going to see cap rate compression happen the way that it did going into 2020 and 2021. I think we'll, again, start to see the late 2020s start to look historically normal by a number of measures with cap rates included in that.
Carl, when you look at demographics and household formation and jobs, are we still upside down? Are we still short on apartment units?
Yeah, so that's going to be a key point to make in the second half of the 2020s here, going into the back half of this cycle. It may not seem like we're undersupplied in terms of housing based on the past 2 years, but really that's a drop in the proverbial bucket of 15 plus years of undersupply of multifamily housing. You look at what delivered in terms of overall housing in the 2000s, it was heavily skewed towards single family inventory. There wasn't a lot of multifamily inventory delivering. Today, that's shifted a little bit where there's still a higher share of multifamily delivering than the 2010s. But keep in mind, those start numbers that I cited earlier have come down so sharply that, again, we're going to be talking about a shortage of housing here really, really soon on the radar. Now, the other thing that I would mention here too, in terms of demographics and household formation, job growth, it's been fascinating to see that multifamily demand has excelled in the past couple months, despite job growth significantly slowing. And we are seeing that job growth is facing the pressures of interest rate increases issued over the past couple quarters. Now, that leads to the question of what's spurring today's apartment demand. And I think, as you point out, it's a combination of demographic growth. It's a combination of household formation. If roommates are decoupling from household units and moving in, starting their own households, we do see that. And then lastly, let's not forget that one of the components of aggregate demand beyond job growth is wage growth. And wage growth remains very strong right now. It's slowing a little bit from where it was a couple years ago, but wage growth is still above what we historically saw as normal in the 2010s. And because of that, we're seeing rent to income ratios for multifamily renters also come down. Apartments are becoming more affordable than they were over the past 2 or 3 years. And I think that that's also helping spur some household formation, further then leading to the overall aggregate demand story for multifamily.
Well, that's good news for everyone, right? The affordability part of it. And I guess if you have new supply kind of slowing down, and we don't have enough housing overall, that means cap rates will probably stay fairly low. There still should be a really asset class that investors want to get into, right?
Yeah, and I think you're seeing that with some of the institutional capital, how that's been allocating over the past, call it 6 to 12 months now. And I think that that's kind of that start of I don't know if it's necessarily the dam is breaking in terms of releasing all that all that capital that needs to be allocated, but at least you're starting to see a trickle flowing into the market. And I think the next, call it 12 to 24 months is going to be really interesting to see what happens from that valuations perspective again, because I think that's still kind of the real unknown in that cap rate equation that we'll likely soon to start figure out in the coming 12 months.
Yeah. Well, Carl, what would you leave our audience with to think about for multifamily?
I think it's still a good asset class to be in. I think it's still, the fundamentals, the drivers between supply and demand still look strong. If you're a developer out there and you can find a way to get a deal out of the ground in 2027 or 2028, and I think you're actually hitting the market at a good time. And there's clearly a need for more housing across the country. I think the Southeast markets, particularly the Sun Belt overall, but especially the Southeast markets, will continue to be a strong area to be in from a simple population growth migration story. These are the areas that continue to see inbound migration. It slowed a little bit from where it was in 2020 and 2021, but the Charlottes of the world, the Raleigh-Durhams of the world, you're still getting a lot of population growth in those markets. So I think, looking forward to 2025, we can expect slightly stronger revenue growth than we saw in 2024. But by 2026, I think we're starting to look at a more historically normal market, which will be the first time we've really seen normal conditions in 6 to 7 years.
Yeah, interesting. Well, I think I have two little sayings I've gotten from this. I've heard before, survive till 25. And I didn't like it, but we're getting closer to 25, so now maybe I do. But I like what you said earlier. We found the floor in 24.
There you go. Find the floor in 24.
All right. Carl, thanks for joining us, sir. Appreciate it.
All right. Always a pleasure. Thanks, Michael.
All right. And thank you for joining us around the country. Hey, please let us know what you think. Please share the show. I remember there's talk about derailing the 1031 exchange. So go to 1031.org and let your representatives know what you think. I think the limiting the 1031 to 500K or eliminate it could really hurt our economy, really hurt banks, farmers, housing, affordable housing, the economy, jobs. It would be terrible. But every 4 years we got to get on our president and our congressmen and our senators. So again, there's a really easy way to let them know what you think. And maybe you think the other way. Maybe you think it should be abolished. But go to 1031.org. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by CCIM C5 Summit. Will be at the Hard Rock Hotel in Hollywood, Florida, September 17th to 19th. Visit c5summit.realestate. By ShareFile. Designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By CREI Summit. This will be in Atlanta, Georgia, September 11th to the 13th, right here in Atlanta, Georgia, where we're headquartered. Visit cresummit.com. By Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.